Hello everyone, and welcome to this week's weekly webinar. I do a webinar about every couple of weeks. I shouldn't say weekly webinar, but I'm glad you were all able to attend. Today we're going to be diving into a topic that means a tremendous amount to me, which is how anyone can get approved for business financing. Now, the reason that this means so much is really part of the reason that I'm here. I, like many entrepreneurs, have struggled to start actually many businesses in my life, doing it on the profits of the business and my own financial contribution. And then years ago, I ran into the system, and I'm now actually part of offering to people called the Business Finance Suite. And I was actually able to discover a ton of financing that I was able to qualify for that I never even knew about. It was frustrating to me at the time because I was getting ready to sell the business, so it was almost too late. I'd already built and scaled this business on my own dime and then figured out how to get money. And like I said, it was frustrating because the first thing that came to my head was, why didn't I know about this? Why didn't anybody ever tell me that there were all of these different ways that I could get money for my business? Why am I just learning this now? And I came to the realization that the reason I didn't know about it was because nobody took the effort to teach me. And that moment was the moment that I decided to become an advocate. It's when I decided to go and dedicate my life to giving as much free information as I could to entrepreneurs about building business credit financing. Because the reality is there's a lot of options out there where you can get financing for a business. The problem is most of them aren't available at a bank. And as I talk to entrepreneurs, I always ask the same question: where would you go if you want money? The answer is always my bank. And my next question is, where would you go if they said no? And the answer is usually, I don't know. So if you're like a lot of entrepreneurs, that's probably what you go through in your head. Where do you go when you need money? You go to your bank. What if they say no? I have no idea. Well, today we're going to dissect this. We're going to look at all the available financing out there that can actually work for you in your business right now, most of which you probably don't even know about. So before we dive in too deep, let me first introduce myself. My name is Ty Crandall. I'm the Director of Business Services here at Credit Suite. If you're interested in learning more about what we offer, you can check out creditsuite.com/business credit. There's no pitch during this webinar. There's no sale. There's no big hook at the end to get you to buy something. Bottom line is we can help you offer business credit financing for your customers. We can help you get it for yourself too. If you're interested, there's the link. You'll see the link at the end of this webinar. I've dedicated my life to business credit financing, written some books, got a lot of information out there about it, and literally have helped 5,000-6,000 people with the help or in building their business credit financing. So I know a little bit about something with this. About this topic, and today I'm going to share with you a lot of what I know that hopefully can help you obtain the money that I think you deserve to have for your business. So we got a lot to cover today. So enough niceties. Let me jump in and actually get to the main content. So there's several types of business financing that's out there. Now, the first main type of business financing is what you're most familiar with. It's called conventional financing. This is what you're going to find at any kind of conventional bank. You walk into Bank of America, Chase, most credit unions, most banks. Conventional financing is what you will actually be looking to obtain. There's also private money. There's several sources out there. We're going to talk about three sources, three different types of private money that are available. And these are investors or individuals that are looking to invest money where they get a good rate of return. And a lot of people look at businesses as being one of the best rate of return and are willing to contribute their own personal funds towards helping you start, build, and grow and scale a business. There's also alternative financing. Alternative financing is where most of the business funding that takes place today happens. And again, there's a lot of products in the alternative financing realm that most people don't know about that we're going to dive in and dissect today. So first, let's take a look at conventional financing. Now, these are mostly SBA loans because all of the big banks and most smaller banks use SBA loans as their primary business funding program. And there's a reason for that. SBA in a lot of cases guarantees as much as 90% of the loan. So what happens is if the bank lends you $100,000 and you default, well, SBA will pay the bank $90,000 and they're only out $10,000, for example. So the risk is very, very, very low because SBA is guaranteeing or backing so much of the loan. But these type of conventional bank loans are very hard to qualify for because the borrower must qualify for the lender's guidelines themselves per and SBA. A lot of people think that SBA is the one that lends the money. That's not true. The bank actually lends the money. SBA just guarantees in case default that they'll basically absorb a certain percentage of the risk. So when you go in to qualify for a bank, you have to meet the bank standards, and then you also have to meet SBA standards. So you're basically qualifying with two different, completely separate entities. entities. Now, SBA loans are also tough to qualify for because they're looking at all aspects of your business and the owner for approval. The way I describe this is the process is basically designed where they will ask you for all documentation, as you're about to see, that they can get, everything to do about you and your business, and then what they're looking for is a hole, a weakness. They're looking for where their real risk is, where their exposure is. So they're trying to get as much information about you and the business as possible with the sole intent of finding problems with you in the business and then turning you down as a result of those problems they discover. So to get actually approved for this kind of financing, everything has to be nearly perfect, from your personal credit to your business credit to your cash flow management to your personal and business, actual bank statements to your actual financials and your projected financials. All of these things have to be nearly perfect to even come close to qualifying for an SBA loan. I give a great example where we had a client come in, had a 780 credit score. He had one Bank of America late payment. It was almost getting ready to drop off his credit card. It was almost like 6 years old. And SBA turned him down because of one late payment 6 years ago because they said it was on a major banking account. So again, everything has to be really nearly perfect to qualify for this kind of conventional financing. Now, I don't want you to take my word for it. So what we're going to do is we're going to look at SBA's actual requirements. And these come right from their website. I've tried to condense this in as few slides as possible so you can get a feel for what SBA actually, or what a conventional loan or SBA loan actually requires to qualify. So they're going to want to see a copy of your P&L statement. Now, it's got to be current within 90 days of application, and you should include supplementary schedule from the last 3 fiscal years included. You're also going to need current and projected financial statements. So what they're basically looking to know is how you cash flow. What kind of money are you generating now? How do you manage that cash flow? And what is your projections for cash flow generation or for handling that cash flow in the future? Now, they're also going to ask you for a business certificate or licensing. Everybody has their own licenses that are needed. For example, if you are in the credit repair industry, some states require that you have bonding. If you are in certain counties, sometimes you have to have an occupational license. If you are a contractor, you might have to have a contractor licensing. Whatever kind of bonding or licensing is required for your industry, in your state, in your city, you must supply along with your application. They're also going to ask you for your loan application history. Now, this is going to be asked for the business and for you individually. So that means every loan you've ever had on the personal side, every loan the business has ever had, they're going to want accounted for. They're going to want to know what the loan amount was for, how you paid it, what the balance is, what the payments are, if anything is outstanding. Now, they're also going to ask for your income tax returns. They're going to want usually personal, and they're also going to want business tax returns. They typically ask for 3 years of returns. Well, right here, a lot of people get stuck because, I commonly hear people say, well, banks don't lend money when you really need it. Well, the reality is most businesses really need money in their early stages of growing. And statistically, when you look at business failures, the longer time period that a business is open, the greater chance of success it really has. So banks don't even want to touch a company that's been open for less than 3 years. They're going to ask you for about 3 years, sometimes 2, but in most cases 3 years of tax returns. So you have to think. You have to have been in business between 3 and 4 years to even be able to supply this, because you need 1 year of full tax returns, 2 years, 3 years, and now you're working in your 4th year. So you have to be in business about 3.5, 4 years to qualify for most of these loans because of this requirement where they're asking for at least 2 years, in most cases 3 years of actual tax returns. Now, they're also going to want resumes, and it's not just from you. But they're going to want resumes from. I don't know if these little dashes are supposed to be above these vowels, but I'll leave them for now. We'll see what happens. Include personal resumes for everybody that owns 20% or greater of your company. So what they're looking for here is just to make sure that you have the past experience to be able to manage basically the business that you're in. So they're also going to want personal background information, and they're also going to want a detailed business plan and a copy of your business credit report. A lot of people don't know this, but it doesn't matter what kind of financing you apply for in the business world. They always pull your business credit. Now, most people don't know this because there's no Fair Credit Reporting Act that requires they tell you this. which means lenders pull your business credit report. They lend you money based on what they see, and they never disclose to you that it's even pulled. So if they decline you, you could be denied and never even know it had something to do with your business credit report. And this is why I'm such an advocate of teaching people how to build business credit, because if you're even thinking about really growing and scaling a business, at some point you're going to have to get money. And in order to get money, your business credit plays a major role. So they will want to see your business credit report, and they're going to want to see that it's good, that you pay your bills to degree, that you don't have outstanding liens, judgments, and pending bankruptcy or lower credit scores on your actual report. They're also going to want to see income tax returns, which I actually went over, and a business overview and history. So they're going to want a brief history of the business, the challenges that you face, the challenges you project to face, and an explanation of why the loan is needed and how it will help the business. Now, it's funny because I was writing an email earlier based on this, that, with our financing, we don't even care how you use it. We're going to ask you what you're going to use it for so we can think of better solutions for you. But when it comes to SBA conventional loans, you have to account for what that money is being used for. You have to map out what it is you're using it for, what the cost of those things are, and in some cases even provide invoices and documentation validating that is a purchase that you intend on making, sometimes even verifying that you made the purchase after you made it. They're also going to want a personal credit report. Now, this is a very long explanation for a reason. I copied and pasted it from SBA. I want you and need you to understand the importance of qualifying for an SBA loan, a conventional loan, and how they look at your personal credit. So this is quote exactly from SBA. Your lender will obtain your personal credit report as part of the application. However, you should obtain a credit report from all three reporting agencies before submitting an application to the lender. Inaccuracies and blemishes on your credit report can hurt your chances of getting a loan approved. It's critical you try to clear these up before beginning the application process. Look, SBA is basically telling you it's critical that you don't even have blemishes on your report before applying. There's no other way to interpret this. And again, from my experience, most people don't qualify for SBA for one reason or another, and it's usually in large part due to the credit needing to be nearly perfect to qualify, to a point where SBA tells you don't even bother applying until you pull your credit and make sure you fix any blemishes on the report so you have the best chance of getting approved. Personal and business credit, very important for qualification. Do you have a business lease? Or do you own the business, the actual building? They're going to want evidence of that either way. Bank statements, they're going to want usually 3 months to 6 months business and sometimes personal. Licenses we talked about, loan application history, proof of collateral. You have to have collateral. On top of everything else we're going to talk about with conventional financing, you also have to have collateral to qualify. As a matter of fact, in most cases, SBA requires 50 to 70% or more collateral against what you're borrowing. So if you're borrowing $100,000, you've got to be prepared to have something worth $50,000, $70,000 or more in collateral to offset the risk of the loan. They won't even give you a loan, even if you supply all of this documentation, until you supply substantial collateral to offset the amount that you're borrowing. And like I said, in a lot of cases, that collateral is required to exceed 50, 70% or more. Legal documents, depending on loan-specific requirements, your lender might require a lot of different legal documents. Make sure you have the following items in order: your licenses, your articles of incorporation, your copies of contracts you have with any third parties. Well, that's like a big deal. Anybody that you have a third-party arrangement with, any software companies, anybody you use that's a third party, they're going to want to see agreements and contracts. If you're a franchise, they're going to want to see those agreements. They're going to want to see any commercial leases, or again, if you are buying the property, they're going to want to see everything about the actual mortgage or loan that you have on that actual property. They're also going to want to know all about ownership and affiliations. So you're going to have to include a list of any subsidiaries and affiliates, including concerns in which you hold a controlling interest, and that may be affiliated by stock ownership, franchise, proposed merger, otherwise. Anything you're involved in, any other company you own or have an ownership interest in, any of your affiliates, all of those things they're going to ask to be listed in detail. Plus, with conventional loans, their lenders also going to ask you a series of questions. These questions basically come from SBA and are required on every single loan application to be answered. What are you applying? Why are you applying for the loan? How will the loan proceeds be used? What assets need to be purchased and who are your suppliers? What other business debt do you have and who are your creditors? And who are the members of your actual management team? They're also going to want details from those people too. Sometimes resumes from the management team. They're going to ask for a list of all the business debt and on top of your personal debt. They'll give you basically a personal and business financial statement you'll have to complete where all this information is provided. On top of that, you're also going to need a current balance sheet, P&L, which we talked about. We didn't talk about the balance sheet. The tax returns, which we talked about, a bill of sale, and the asking price. This is all necessary if you're buying an existing business. So if you're buying an existing business, you're going to have to provide the balance sheet and the P&L, what you're buying, the tax returns of the business you're buying, the bill of sale, and the asking price with schedule of inventory, machinery, equipment, furniture, and fixtures. Basically, so the lender and SBA can get a very detailed look of exactly what it is that you're qualifying. So the next statement's pretty obvious. There's no question that SBA loans are tough to qualify for. They're ridiculously tough to qualify for. As a matter of fact, I always ask entrepreneurs the same question. How many people do you really know that you've ever talked to who have ever secured an SBA loan? Now, you'll talk to people that occasionally do. I'm in a position where I talk to probably more people than other people because I talk to a ton of people that are applying for financing. But the bottom line is, if you think about it, how many people do you know for sure, 100%, that you've ever talked to who have ever successfully secured an SBA loan? Now, if you're like most people, you definitely can't count that figure. You can count that figure on one hand. There's definitely, in almost all cases, not more than 5 people you know. In most cases, most people don't even know 1, 2, or 3 people who've ever secured an SBA loan. Well, there's a reason for that, because they're extremely difficult to qualify for, as you just saw. Conventional loans are the hardest loans, hands down, no questions asked, to ever try to get approved for. So if your intention is to walk into a bank to get approved, good luck, because everything you just saw is what's required. And if you think about everybody or anybody you've ever known who's been successful in getting an SBA loan, that'll probably give you an accurate depiction of your potential success if you move forward to apply. So according to the Small Business Lending Index, over 89% of business applications are denied by the big banks. And what's ironic is that 90% of businesses statistically fail, and yet 89% of applications are denied by big banks. Now, me personally, I see a direct correlation here. What I see, and per SBA, the major reason for business failure is lack of capital. So knowing that one of the reasons for most business failures is that they're not able to get money, and knowing that 89% of applications are denied and 90% of businesses fail, I see a direct correlation there. Bottom line, most businesses fail because they can't get money, and most businesses fail because they can't get money because they go to their bank to try to apply, and their bank denies nearly 90% of those actual qualifications. So most business owners struggle to get approved because their business just isn't perfect. Their business credit isn't perfect. They don't have tax returns for 3 years that show increasing profits. They don't have really in-depth business plans, P&Ls, balance sheets. They don't have 50, 70, 80% collateral for what they're borrowing. Most people don't have one or many of these things. And as a result, the business owners don't get the funding they need, and a lot of them, unfortunately, end up going out of business. As I said, SBA themselves says that one of the main reasons for small business failure has to do with this one thing, which is lack of access to capital. So yes, you can go with option 1, which is conventional financing, but I'm a realist, and I want you to know exactly what you're up against, because more than likely you don't know very many people, if anybody, who've ever successfully went through this process and secured a big loan. Okay, but there's a lot of other money that's available outside of these sources. Just keep in mind, if your goal is to go to your bank first, now you know what requirements you're going to have to meet to be able to qualify, and you have to understand going in, it's a really, really big uphill battle. But let's talk about another option. Now, we already talked about conventional financing, and the second one I listed to you, or for you in the initial slides, or private money financing. So private money financing is another great way to get financing. Probably one of the better ways, well, not as good as alternative financing, but by far better than conventional financing. So there's three main types of private money you're going to experience: equity investors, private financing, and crowdfunding. Now, I have crowdfunding listed as two words here, but it actually is one word, and you'll see it listed as one word as we get to those slides. But regardless of whether it's one word or two words, there's three really solid options that are very different from each other that are available, that involve individuals giving you money based on your business, your concept, your idea. So let's dive in. The first is equity investors. Now, what equity investors do is they basically contribute money to your business in exchange for a percentage of equity or ownership in your company. Think Shark Tank. Okay, a lot of you are on this webinar because you're entrepreneurs, and I'm sure, like me, you're obsessed with the show Shark Tank. If not, you should at least check it out because it really gives you a very good reflection of what equity investors are looking for to invest money into your company. And basically how it works is quite simply they listen to your idea, they listen to your concept, they look at your product, they look at what you have, and they basically say, we like this. We're going to give you the $100,000 you're looking for, but in return, you're going to give us 20% ownership equity in your company. So with equity investors, you're exchanging equity in your company in return for the money. That's why you'll commonly see them listed as equity investors. Now, the percentage of ownership is based on risk. It typically varies from 20 to 60%. It really varies more than just risk. It also varies based on the time commitment that they might have to commit. If you ever watch the show Shark Tank, sometimes they'll say this. They'll say, look, I want 60% ownership of the company because you have a concept. I'm going to have to do a lot of work to help get this off the ground. I want more ownership. So it might be on your risk or the risk of the proposal actually succeeding. It might be based on the actual time commitment, energy or financial commitment beyond your initial investment that they have to contribute. But usually percentage of ownership goes anywhere from 20 to 60%. Sometimes it can be less. It could be 5, 10, 15%. But in most cases, to make it worth their time and for them to get the return they're looking for, they're usually looking for a range of 20 to 60% ownership of your company in exchange for the money they're giving you. It's a viable option for startups, though, because with equity investors, you don't need tax returns. Okay, they're typically not required. The idea might be enough to attract an investor. Now, again, I love the show Shark Tank because it just gives you a perfect example. It's obviously easier for people to go on the show and in real life to get money if you have a proven concept, if you have sales. And I always use this example because if you ever see the show Shark Tank, you always know one of the questions they're going to ask from the very beginning is, what are your sales? And the minute the person says, I don't have sales, they cringe. They sit back in their seats. They immediately lose interest. It's having sales in a proven concept, meaning not just that you have a good idea, but you have a good idea that you've released to the marketplace has accepted it, and they're buying it. That's what equity investors are really looking for, is a proven concept. But they might buy just an idea if the idea is strong enough in their eyes to be able to attract customers. So investors will want to see value, such as a product with patents if you're coming in this way. Meaning if you're coming in with just an idea or concept, well, then what they're going to typically want to see is they're going to want to see how good is your idea and what do you have that makes your idea just yours. Do you have patents? Do you have trademarks? For example, that's what they're going to want to see. Okay, hey, you have this great product, and this product is whatever. It's a cereal bowl that holds the milk on one side. Okay, it's something I've seen on Shark Tank that's really out there today. So it's a great idea. Now the question is, do you have a patent on that? Is that idea or concept truly uniquely yours? And what kind of patent do you have? Do you have a utility patent? What kind of patent do you have? So if you're coming in without tested, proven concept and sales, but typically you want to see that you have trademarks, patents, things like that, that your idea is yours and nobody else can basically take it and duplicate it. And in many cases, they would prefer to see a tested and proven concept over just an idea. Well, that's kind of a given. If you're going to put your money into a company, you'd rather know that that company's being successful and everything is happening as that owner expected than just investing into a concept in which a million problems occur along the way as getting that concept off the ground. And any entrepreneur knows this. It never works out like you think it will. The devil's in the details. You start mapping out profitability and all these things, and a million variables come into play you didn't anticipate. And those variables could lift you up or put you out of business. And it's those variables that equity investors aren't sure of, so they would prefer tested, proven concepts, but will absolutely invest in an idea if the idea is fresh, good, they see the scalability of it, especially if that idea is backed up with uniqueness, something and making it truly yours, such as patents. So private and financing. Now, this is the second kind of really private money that's out there. There's equity investors. Then there's private investors. Private financing serves as basically SBA fallout financing for loans that might be close but just can't qualify for SBA. So collateral in most of these cases is required, although the collateral requirements are much less than SBA. So with private financing, you do not have to typically give up equity ownership in your company, but they want to see you have an established company. They're going to ask for tax returns. They're going to want to see you have evidence of sales. And they're going to require collateral, although the collateral might only be for 10 or 20% of what you're borrowing versus SBA that might want 50 or 70%. And again, they're going to want to see 2 years of tax returns. So no startups. And this is another myth that a lot of people come to us with. They say, well, hey, I've got this great idea. It's a startup. I want private money. Well, you want an equity investor. You want to take your idea and get it in exchange for equity. And we don't really deal with equity investing because we don't like the concept of people giving up massive percentage of ownership of the company in return for the money, especially when there's so many other viable options. But with a real private investor where you're not giving up equity, they're going to ask for tax returns. So you're not going to be able to qualify as a startup. They might only want 2 years of tax returns, whereas SBA in most cases wants to see 3 years or more. An executive summary is required, and lenders are looking for an average credit score of 650 or higher. That's about it. So they're not going to typically ask you for P&Ls and projected financials and current financials and all of your bank statements and your personal bank statements and your business credits and necessity. They don't look at all that stuff we look through with SBA. All they're really looking for is tax returns that show you make a profit, that show that your profits are increasing. An executive summaries gives you them a good overview of your company and you and everything involved, and average credit. It doesn't have to be 780 plus like SBA usually requires. As a matter of fact, we've had SBA lenders tell us not even to bother applying for SBA unless the score is 780. But with private financing, you can easily get approved with even average credit scores of 650 or higher. Now, loans can be very high or even smaller. We've done, loans as low as $250,000, or you can literally get loans of billions of dollars. We are actively involved right now in a project for $1.4 billion. So dealing with private financing to get this funding gig off the ground. So it's very diverse of how much you could use or get access to through private financing. Again, smaller amounts might be $250,000, even to billions of dollars. The loans take about 30 to 90 days to close and receive funds. In a lot of cases, it's 30 days or less. So it's definitely faster than SBA loans, but it's not as fast as some alternative financing where you can get money in a week or so. You're usually dealing with higher dollar amounts here. There's more due diligence required on the lender's part to research you and your company, so loans will take a little bit longer. And interest rates are usually 7% plus depending on risk. Well, that's pretty fairly comparable to SBA. SBA in a lot of cases nowadays is 5 to 7%. Private financing is 7%. So clearly beneficial. You can get a loan that's got an equivalent kind of rate as SBA, long-term. Sometimes they're 5, 10, 20 years long, or sometimes they're lines of credit, but the requirements are much more lenient than it ever would be on an SBA loan, which is why I really classify these as SBA fallout loans, because they're loans for, companies that have documents, they have tax returns, they have profitability, they're established businesses, they have average credit, they have collateral, but they don't have exactly what's required for SBA. But if it doesn't meet SBA requirements, private financing is absolutely a great solution. So the third kind of private money financing is crowdfunding. Now, crowdfunding is basically the collection of finance from backers or a crowd to fund an initiative. So the initiative is your project, your business concept, let's say. Okay, crowdfunding is the collection of financing from the backers or a crowd of people that believe in your initiative or concept. So crowdfunding models involve a variety of participants, including the people or organizations that propose the ideas or that have the initiative or concept, and the crowd of people who actually support the proposals, or the crowd of people that give that concept or proposal the actual money. So crowdfunding is then supported by an organization or a platform. So there's a lot of these platforms you now see. Like you'll go on Facebook and somebody's trying to raise money, so they'll have a GoFundMe account. Well, GoFundMe is an example of a platform which basically brings the project initiator, the one that has the initiative, and the crowd together and actually connects the two together. There's a lot of benefits. Crowdfunding allows good ideas which don't fit the pattern of conventional financiers or really any financing to break through and get money, okay, based on the crowd. So if you say, look, I have a great idea. Man, this is an awesome idea. There's no reason you shouldn't buy into this. So you go to equity investors and you go to private investors, and let's say they won't give you the money you're looking for. But you say, you guys are crazy. You don't know what you're talking about. Well, crowdfunding might be a perfect avenue, because then you put your concept or idea to the crowd and you rely on the wisdom of the crowd saying, hey, that is a brilliant idea. Let me give you all kinds of money. And they give you a lot of money towards that concept just because you had a general idea that might work. And you hear these all the time. I'm just trying desperately to think of a very recent example from last week, but it escapes me, where somebody just had a really basic thing they were looking to accomplish, and they put something up on GoFundMe looking for $5,000, and it immediately, within like 48 hours, got over $50,000 in money contributed, because the crowd and the wisdom of the crowd said, that's a freaking brilliant idea. I'm all in. So that's what a crowdfunding will allow you to do, is that it brings the concept to a crowd, and you rely on the intelligence of that crowd to make a decision of whether or not that concept is good. Okay, and if it does achieve traction, and that's what I'm basically describing, perfect example that I just gave. Somebody that says, hey, I want $5,000, he gets 50. Well, that's gaining traction. That means your concept is wildly accepted. And when this happens, not only can the enterprise secure money that you need to start the project, but it also secures evidence of backing from potential customers and benefits from word-of-mouth promotion in order to reach the fundraising goal. Let me give you a perfect example. My wife shows me 2 months ago something you put at the top of the stairs, and it unfolds and turns your stairs into a slide. Well, I'm like completely into that. Not only just for my own purposes, but for the purpose of having a 3- and a 5-year-old. Like, my little kids would absolutely love that. Like, we would spend 6 hours with our dogs playing on the slide. It's awesome. Because it's so cool, everybody on Facebook was sharing it. That's how I saw it. I think my wife maybe found it on Instagram. So what happens is people see this concept and they say, this is awesome. I want it. It's so cool. And then they start sharing it on Facebook, and they put the video on YouTube, and they start talking to people about it. And now all of a sudden, I'm telling you about this concept. So not only did this concept gain money and gain traction, but now they already have literally thousands of people ready to buy the product when it's released, because they put it on a crowdfunding site and it basically went viral. So those are other additional benefits that you're able to gain out of actual crowdfunding. Now, a compelling project can raise a producer's profile and provide a boost to your reputation also. So also, you can get a major boost. Your company could be put on the map by this. Maybe nobody even knew who you were, and then all of a sudden you roll out a concept, and now all of a sudden you're padding your reputation because your concept is taking off in a crowdfunding platform. And again, as I already mentioned, you're basically gaining an audience. If you have a concept especially that's wildly accepted and shared and promoted by these other means, and you're basically marketing the product in the exact same time that you're trying to gain money. Crowdfunding creates a forum where project initiators can engage with their audiences. This is something completely different too. Okay, so now, in a perfect example is that slide that I explained, the thing that unfolds and makes the stairs into a slide. Well, when you look at that project, they opened up the comments. So everybody's putting in comments, hey, that would be awesome if it had a turn at the end. That was one of the comments I saw. That was a great idea. It would be cool if it turned at the end So, because I have like a wall at the end of my stairs. So people start putting in ideas of how to make the actual concept better. So the audience can engage and actually be part of the production process, which is like ridiculous. A normal company has to release the product and go through a beta test to get feedback. But with crowdfunding, you can roll out a concept and get tremendous amounts of feedback without even doing a beta test. You could construct the product based on what the buyers are going to want just because the buyers are giving you the suggestions before you even put the actual product in the marketplace. Okay, so it basically gives you a tremendous amount of feedback. And another massive benefit of crowdfunding is that the owners retain control of their operations. So with this, unlike equity investing, you don't have to give up a percentage of equity ownership in your actual company. Now, let me clarify, because that's not always the case. There are crowdfunding platforms where you will give up a portion of equity in your company in exchange for the money. There are some that are built just like equity investment. But for the very, very, very most part, 95% of crowdfunding sources, you don't have to give up a portion of equity for the money. In a lot of cases, you don't have to give up anything. In some cases, they do ask you to give up equity. In some cases, you exchange the product when it's designed for the money they're initially giving you. They're all a little bit different. But the most widely accepted model of crowdfunding is you put an idea out, they give you money expecting nothing in return, although there are a lot of other different models beyond that main model. So now we're going to spend a lot of time, and let me see where we are into this, probably, I guess, the remainder of the time, the majority of this webinar, talking about what's most common in the business world, or is this alternative business financing. This accounts for most business financing that takes place out there, because the reality is there's a lot of capital out there that business owners can obtain, but it's just not available through a bank. Okay, over 90% is available through the big banks, and these are alternative financing types. I saw a statistic from the Bureau of Labor and I don't know who it was, one of the government agencies, that showed that SBA loans only account for less than 2% of all loans. I got scared even putting 98% on the slide, but that's the reality. Most people go to their banks first, but yet SBA conventional loans only account for less than 2% of all business financing that's out there. Most business financing, over 90% of it, really falls into this category of alternative business financing that isn't available through banks. So most alternative sources will lend you money based on a business strength. So as long as you have a strength, you can be approved. Keep in mind, radically different than conventional financing. Conventional financing, everything in your business has to be near perfect to get approved. You can't have a weakness, but with this alternative financing, they just want a strength. That's singular. That's not your whole business has to be perfect. We just want something to hang our hat on, a strength showing that you're a good lending candidate. Now, I personally have deemed this the 3 C's of lending. There's 3 strengths that you can have to basically qualify for financing. The first is cash flow. Pretty simple. You have consistent cash flow coming in. There are a lot of lenders out there that have metrics that support that if you are a business that's doing consistent business and your revenues are consistent, that you're very lendable just based on the fact that you're bringing in consistent cash flow. There's other sources out there that will lend you money just based on your collateral. Now, here's what's cool. They don't need each other. So with cash flow, you don't need the other 2. With collateral, you don't need the other 2. And with credit, good personal or business, you don't need the other 2. So let me give you an example. If you have consistent cash flow, you can get money even if you have strike through, no collateral, strike through, bad credit. If you have collateral, you can get approved for financing if you have no cash flow and bad credit. If you have good credit, you can get financing if you have no cash flow and no collateral. This is the beauty of it. Alternative financing, you need a strength, and you can get approved based on that strength, ignoring the weaknesses. So if you're weak in these other 2 areas that conventional lenders require you be strong, you're done at a conventional bank. But with alternative financing, you can be strong in one area, weak in the other 2, and still qualify for for business financing. So cash flow financing is one of the most popular types of business financing today. I mean, as a matter of fact, if you look at ads relating to getting business financing with bad credit, and they're everywhere, right? You see them on Facebook. You see them on Google when you type in whatever, financing. Bad credit ads for financing are everywhere, and those are usually referencing cash flow-based financing programs. Now, the really good example of this is if they advertise no startups. Get approved for $150,000 and get paid in 72 hours if you're not a startup. No startups accepted. That's a good indication that they're looking at some kind of cash flow financing. Okay, so the two most common kinds of cash flow financing are merchant advances that most people are familiar with, and business revenue financing, which is the up-and-comer. This is quickly becoming one of the leading forms of business financing out there, and it's not as complicated or costly as a merchant advance. So there's a few things you just have to ask to see if you're a good candidate for cash flow financing. Do you have existing cash flow proven by bank statements? Do you make over $60,000 a year received in credit card sales? Or do you have over $150,000 annually through your bank account? I say $150,000. That's not fair. Nowadays, if you have $10,000 a month in revenue or $120,000, you could typically get revenue lending. If you have $60,000 or more in credit card sales, you could typically get a merchant advance. Okay, and they're all looking for the same thing: consistent cash flow proven by business bank statements. So revenue lending, these are short-term loans, 6 to 18 months. How it works is this: usually in the beginning, you're getting a short term, 3 months, 6 months, 9 months. If you have really good credit and really low risk in other areas, they'll give you 12 to 18 months. Most clients we see get 3 to 9 month initial term, and then basically in 3 to 6 months, they renew that loan and get 12, 18 months terms. So you'll get longer terms once you prove yourself. Initially, it's a tough go because they're usually shorter term. The loan amount's up to $500,000. Well, the loan amount's based basically on your revenue. So the loan amounts are equal to 8 to 12% of your annual revenue. A good easy way to do this is just pick a number in between, 10%. 10 is just an easy number to deal with. So if you make $5 million a year, 10% of that is $500,000. If you made $5 million a year, you could get $500,000. Most of you on this webinar probably aren't making $5 million. So let's talk practical numbers. Let's say if you were making $500,000 a year in revenue, well, you could get 10% of that advanced to you initially. $50,000 advance is initially what you get. So they look strictly at your cash flow. What are your deposits into your bank account? Let's add them up. Let's figure out about what you make for a year. They'll look at 4-month statements to come up with an average. And then we're going to give you 10% basically of that is what will actually happen with cash flow financing. Rates are 10 to 45%. I've seen rates as low as 8 to 10% on this financing, but it's not common. Those people have really low risk. Like, they've been in business a long time. They have a ton of money going through their bank. They have a bunch of extra money left over in their bank account. They've got good credit. You don't have to have any of those things to qualify, but the lower risk, the lower the rate. In a lot of cases, if you're coming in, you've got bad credit, you've got no collateral, you manage your bank account okay, well, then you're probably going to get 20, 30, even 40% payback on your actual money. Seems crazy, seems outrageous, but believe it or not, we see that over almost 90%, 86% of our clients not only get the financing, but come back and renew the financing. So we see almost 90% of clients that obtain this kind of financing come back in 3 months and get more. Then what happens when they get more? The term gets longer, the rates get much less, and then they can get even more money. So let's say in this guy's case, he got 50 grand. We could come back in 3 months and get another 40 grand, and even with the extra 40, his payments wouldn't change much because they lengthen the term and lower the rate. So cash flow financing can be scary at first because rates are high, terms are short. But what the lender's looking for is they want to prove yourself. They want to say, look, this isn't the kind of money you just get to have laying around. This is the kind of money you get to invest into something that makes you more money. Okay, so with this, you're basically going to pay more money in the beginning, and as you prove yourself, your terms get better. You can get approved with a 500 credit score. No collateral is required. Cash flow financing or merchant advances are exactly the same. Okay, you can get a revolving line of credit in some cases with merchant advances. Term is the same. They're going to usually do 1 month of processing volume. Okay, so that's 10 to 12%, just like revenue lending. Rates are the same. Credit score, collateral requirements are the same. Really, merchant advance and revenue lending qualifications are about the same. So let's talk about another alternative kind of financing, the second C, collateral-based financing. Well, there's a lot of collateral, and people ask me, what kind of collateral? I said, do you have any kind of collateral? And they say, well, what kind of collateral are you looking for? And I say, what kind of collateral do you have? Because most forms are accepted. Account receivable, stocks, bonds, cash on hand, inventory, purchase orders, equipment, 401k, real estate, floor plan, book of business. I didn't spend a lot of time on these lists because we're going to look at these individually. The bottom line is, do you have something worth value that could be collateral? If so, you might qualify. Now, account receivable financing is if you have receivables or other people that owe you money. And instead of waiting to get paid, you can get 80% of that money advanced to you right away. They require that you be in business a year. The receivables have to be from the government or another business, but the rates are ridiculous. 1.25% to 5%, usually less than 2%, regardless of credit. You heard me right. I don't care if your credit score is 350, the lowest you can get, you're still going to come out with a 1 or 2% interest rate. It's crazy because they don't care about your credit. They care about who your receivables are with. So if you're dealing with a reputable company, rates are low regardless of credit. Let's say you have stocks or bonds. Well, you can get a line of credit up to 90% using those stocks or bonds as collateral. And the rates, again, are very low, 2 or 3%, regardless of personal credit. You can use this as an open line of credit for whatever you want. And again, you can get approved even if your credit's very, very bad. Inventory financing. You're using your inventory as collateral for financing. This works great for a retail store or a factory or somebody that has a lot of different inventory. The minimum inventory loan amount, the smallest loan amount you can get is $150, and they'll usually give you a loan amount or a loan equivalent to 50% of your inventory value. So in order to qualify, since this $150 is the smallest loan amount, you obviously have to have $300,000 or more in inventory. But if you do, then you can get financing for about half of that, which is about $150,000 or more. You can't lump together inventory. So a lot of people say, well, hey, Ty, I have inventory. Like I have like 10 desks in my office and each desk has a printer. Well, that's not inventory financing. We're talking about inventory on shelves. If you've ever walked into a retail store and looked in their back room, that's inventory. Boxes and boxes of clothes or whatever it may be stocked up on shelves. If you've ever walked into a factory and seen, you know, literally shelves that sometimes are 50 feet tall with boxes of inventory that they're pulling down with forklifts or such, that's inventory, not stuff that's lumped together. And rates are normally 2% monthly on the outstanding loan balance. Again, regardless of personal credit, you can still get very, very, very good terms. And I already gave you the example of a factory or retail store is a good fit for inventory loans. Now, purchase order financing is quite simply this. You're expected to produce a product for your customer. And in order to produce your product, you have to buy supplies to produce the inventory. Now, perfect example is one of our clients supplies the plastic glasses that you get at Busch Gardens, like the mugs that look like dinosaurs or whatever. Well, he gets a big order from Busch Gardens, he has to buy the plastic to manufacture those. So he has to go to a supplier to get the plastic to manufacture the glasses. Then he gets the glasses to Busch Gardens and might not get paid for 90 days. Well, purchase order financing would allow him to basically not have to buy the supplies, but the lender buys the supplies for him, or up to 95% of that purchase order, the lender supplies the money for, the customer, the business owner supplies the other 5%, and they get their actual money. The lender gives the supplier a letter of credit, the supplier ships the actual supplies, the money is released to the actual supplier and then that business owner gets their actual supplies they need to produce their product. So that's only applicable if you have purchase orders. Equipment sale leaseback. This is pretty simple. You have a massive piece of equipment worth a bunch of money. The lender says, we're going to buy the equipment from you, okay, and then we're going to lease it back to you. So you're selling the equipment to the lender. The lender's leasing it back to you, which is why they call it equipment sale leaseback. Now, the lender's usually going to look at the fire sale value of your equipment. What would it take to sell it at auction? So in a lot of cases, it might be 50% of the actual retail value is what they're going to value your equipment at. They're only looking at major equipment. Again, not like printers in your office, but big piece of equipment worth a good chunk of money. Lender won't combine a bunch of small equipment. They're usually going to ask for first and last month's payment required. I list that because we had a client that was surprised. First and last month's payment were $3,000 or $4,000. They didn't have that. So you need to expect that you're going to have to pay first and last month's payment. And you can get a loan up to $2 million if you have the equipment for this. And again, one of my clients that produced those Busch Gardens glasses, I'd walk through his factory. He's got like $5 million of equipment. He could use any of like 50 machines as collateral to qualify for financing. So you have, especially factory owners or people that have big pieces of equipment or even heavy equipment, can always all be used for equipment sale-leaseback. We do a ton of 401k financing, a ton of 401k financing. Very popular program for us. 401k or IRA can be used. This next slide is wrong. You can actually get up to 100% financing of 401k. They let you put more money in and borrow against it, but who would want to do that? So from your existing 401k, you can get up to 100% financing, rates less than 3%. You basically have your corporation set up. They establish a retirement plan for your current company. Funds are rolled over from your old plan to your new company's plan. The new plan purchases stock in your company, and then you're set. You're good to go. You got to think a 401k is you investing money in other people's companies. All 401k financing does is it says now you buy stock in your own company and you can get a line of credit against it. We had a great bar owner who needed 25 grand. Bank turned him down, had a 401k worth $750,000, and we got him like $500,000 line of credit. So great way to go, especially if you believe in your business. You're basically investing in your own company's future, not another company's. If you're flipping properties and you have a mid-600 score, flipping experience, and cash in hand to put into an escrow account, you can get as much money to buy 100% of that property and rehab it. You just can't exceed 65% of after repaired value. So House Reseller program is very awesome because most banks won't lend money to real estate investors right now. The House Reseller will work. 8% rate or so can go as high as 18%, 6-month term because these are designed for flipping properties. If you are an auto dealership, which I'm going to only spend a minute here because most of you aren't, you can get a revolving line of credit where you're using your automobiles, your cars as inventory, and as you sell each car, you basically pay back a portion of that line of credit. And if you're an insurance agent, then you can actually use the commissions on your book of business as collateral for financing, and you can usually borrow 2 to 3 times of annual commissions to get a long-term loan. So a lot of different options for collateral-based program financing depending on the actual collateral that you might have. So let's look at the third C, credit-based financing. Well, if you have good personal credit, you can get unsecured credit cards and lines with a personal guarantee. If you have good business credit, you can get unsecured credit cards and lines with no personal guarantee. So approval amounts range from 10 to 150 grand. With these good personal reporting on the unsecured program, they don't report to the consumer reporting agencies, which is awesome. They only report to the business credit reporting agency. So you build your business credit and you don't harm your personal credit. 30% of your personal credit score is based on available credit. So this is a really big deal that they report to business and not personal. Excellent personal credit with open revolving credit is required to qualify, and low inquiries. And approval amounts are equal to your current limits. You can usually get 5 times the amount of whatever your highest credit limit account is. So if your highest credit card limit now is $10,000, you can usually get 5 times that, which is 50 grand. And pretty good rates, 0 to 25% APR, usually 5 to 25%, 0% usually for 6 to 18 months. And our lender charges a 9% success-based fee. Everybody else I know of in the space charges 10 to 12% fee. Some of them even charge up front, but it at least gives you an idea of the fee for that. Now, if you built your business credit, you can also get 10 to 50 grand usual limit cards there. They report to the business credit reporting agencies. It takes about 6 months to build your business credit to qualify, but who cares? I mean, this is a catch-all. So let's say you have nothing I've talked to you about today. Let's say you have no cash flow. You have no collateral, and you have bad personal credit. Well, business credit's awesome because you can get individual credit cards with limits of 10 to 50 grand in 6 months. That's ridiculous just by building your business credit. You just need to dedicate the 6 months to build the business credit profile, and personal credit's not even used in the decision. So even if you have bad personal credit, it doesn't matter, and approval amounts, again, are equivalent to current limits. So as you build your business credit, your limits get higher, once you have even one $10,000 limit card, we advise clients to start applying for Visa, MasterCard sources and getting individual cards of 10 to 50 grand. In our finance suite, we have 12 of these accounts. That's like $120,000 in credit somebody can get in 6 months to a year with bad personal credit, no collateral, no cash flow. That's insane. So this is a good catch-all, even if you don't meet the other requirements we talked about. And the rates are pretty much the exact same. 0% for 6 to 18 months, 5 to 29% after that. So that's it. I'm going to go ahead and wrap this up. I literally have a webinar at 3 o'clock today, so I don't have time for a lot of questions. I did see a question before we even started the webinar, though, about getting started with us and possibly becoming a reseller. Again, I'm not going to pitch. I don't pitch during this type of webinar, but you can check us out, creditsuite.com/business credit. That'll give you all the information about getting started with us. So now you've got a ton of free information. You understand about private investor money, and private equity. You understand crowdfunding. You know about alternative sources of financing. You know what's really required with your bank to qualify for conventional financing. And at least now, hopefully, you know what to look for so you can get out there and start getting some real money for your business and not fall into that trap where you're trying to qualify for conventional loans and not able to get approved. So hopefully you got a lot out of this today. If you have any other questions, feel free to reach out to us. Here's our number, 877-600-2487. And my email is ty@creditsuite.com. That's spelled Ty at creditsuite.com. Feel free to reach out to us with any questions, anything we can help you with. And also check out my YouTube channel. There's a ton of cool information on there on how to build business credit, obtain financing that I think can be really useful and beneficial for you. So hopefully you got a lot out of this webinar. I want to thank everybody very much for taking the time to attend, and I hope you all have an excellent, a very awesome day. Thanks, everybody.